A very good morning to all. Welcome to the Commodity Weekly Roundup with me, your host and guide Ravindra Rao from Kotak Securities. Well, volatility was at an unprecedented level last week and with no end in sight of Russia Ukraine tensions so far. Last week we saw commodities correcting from multi year highs while equities recovered from lows and the US dollar index retreated from multi month highs. The move shows that the market players are positioning for possible resolution of tensions. Russia Ukraine fighting has been going on since Feb 24, and there are no signs of resolution yet. There were some signs of reconciliation last week, but nothing materialized. Commodities have also come off the highs amid worries about impact of higher price on demand and on concerns that exchanges may take more measures to manage price risks, increasing higher trade margins. Market players have now shifted focus to central banks. ECB last week surprised by taking a relatively hawkish stance. ECB expressed downside risks to the economy. However, it slowed the bond purchases rate for next 3 months and said that the bond buys in Q3 will be data dependent, signaling an early end to the bond buying program. Gold has hit August 2000 highs last week but failed to sustain and has slipped back below $1950 level. The sharp rise and sharp correction reflects increased sensitivity to geopolitical development and movement across commodities. Russia Ukraine tensions are far from over. However, market nervousness is easing with more efforts to resolve the issues and some positive statements. While Russia Ukraine tensions and inflation expectations continue to remain key price determining factor for gold, focus has shifted to central banks now. ECB surprised last week, but taking a relatively by taking a relatively hawkish stance despite increasing risk to Russia-Ukraine tensions. Market players are now gearing up for Fed decision this week. Fed is expected to raise interest rates by 0.25%, the first rate hike since the pandemic. Rate hikes are negative for gold, however, it has largely been factored in. Market focus and reaction will be more on Fed's future stance. A sustained fall may come in gold only if there are concrete efforts to resolve Russia-Ukraine issue, or if Fed surprises with a bigger rate hike at current meeting, or projects multiple rate hikes this year as against the expectations. Overall, gold may remain volatile as market players position for a Fed meeting and react to Russia-Ukraine developments. However, buying interest may emerge at lower levels if geopolitical risks continue and central banks take a cautious approach on tightening. On the technical front, gold is trading below the initial support of $1960, and the next support is near $1914, 1912. So until that holds, there is a possibility that we might see some kind of a pushback. And if Fed is not very much hawkish, then there is a great chance that we might see a pushback towards 1980, $1980 an ounce again. The Fed will be in focus, and we need to wait and see what will be Fed's stance. In case of energies, crude has retreated from highs as positive comments from Russia and Ukraine has fueled hopes of a possible resolution. Ukraine showed willingness to consider Russia's neutrality demand, while Russian president said there were positive undertones in talks. Crude has been volatile as market players assess possible replacements for Russian supply. US and other countries have called upon OPEC to boost output in wake of disruption relating to Russia-Ukraine. However, the oil producer group has maintained its gradual production hike stance. Saudi Arabia and UAE are a few of the countries who have spare capacity and can boost supply. US and allies are also considering a release of stocks from emergency reserves. IEA has already announced a release of 60 million barrels and is willing to do more. However, market players are not hopeful that it will impact much owing to small quantum. Also, US crude stocks in strategic reserves have slipped to 2002 lows, and the country may not release much stocks unless it sees a severe emergency. Market players were also looking at Iran for higher supply. Crude oil has corrected nearly 20% from the highs, and this has brought an unsteady halt to the rally. And we now need to see if it can continue longer or not. While supply risks relating to Russia may continue to be a key price determining factor, focus this week may shift to central banks as well, which may impact currency movement along with the risk sentiment. Overall, crude sharp rise has made it vulnerable to profit taking. However, a sustained decline may not materialize unless Russia-Ukraine issues are resolved. So we expect NYMEX crude to trade anywhere between $96 per barrel to $108 to 110 per barrel this week. And possibly buying might emerge at lower levels if the geopolitical tensions continue. On the technical front, crude is approaching towards the support of 95.50 NYMEX crude, and if it takes that support, there is a possibility it might once again bounce back towards 106, 107 7 levels, and that is why we are expecting a range between 95 to 107, 108. If it breaches 95, 94 on the lower levels, then it might move towards 88, 89. But as of now, it looks a little unlikely. But if the tension subside, we might even see crude moving lower. In case of natural gas, it has been trading very much in the range, and we expect this range to continue. On the higher side, natural gas is taking resistance near 370, and on the lower side support is seen near 338, 335. This is on MCX, and we expect this range to continue, and the consolidation might continue this week also. Lastly, in case of base metals, we have seen crazy moves in nickel, and we also saw trading being halted, suspended from LME. It saw a unprecedented 250% rally in just 2 sessions. This was due to extreme short squeeze. Um, other base metals. Other base metals have been trading a bit on the lower side, mainly because of the suspension in nickel trading, and even the margins were increased, and that's why we have seen some kind of a down move, a corrective move in almost all base metals. This week, metals may continue to trade with caution as global investors await key economic data from China and FOMC monetary policy statement. Besides, a worst COVID-19 outbreak in China since 2020, and this is resulting into lockdowns, which has added fresh concerns about the growth. Technically, copper on the MCX has good support near 790, 792. Until that holds, it might trade in a range of 790 to 820, 825. But if 790 is taken out on a closing basis, we might see it further falling towards 770, 768 levels. And in case of aluminium, prices are looks little on the downward trajectory, and on the lower side, 265 would act as a good support. If that is taken out, we might see aluminum prices drifting lower towards 250, 245 also. And similarly, on the upside, resistance is near 280, and if that is taken out, we might see aluminum prices further going higher towards 287. So slightly on the lower side with a lower bias, but we need to see Fed's stance, and also what is happening in China to take a further cue. To sum up, the main focus for the week will be on FOMC meet. Although a 25 bips hike is expected, all eyes will be on the Fed's future stance and how they can strike a balance between geopolitical instability and the ballooning inflation. That's all from this edition. Good luck and trade safe.